Great returns aren't luck, they're built on the floor. Operators and investors always pushing for more. From the deal sheet signed to the systems in place. Speed without precision is just running a race. Operational velocity, where execution sets the pace.
Welcome to Operational Velocity. Before every middle market PE fund started hiring operating partners and calling it Operational Alpha, two brothers from Bethesda, Maryland were quietly building the template. No fanfare, no TED Talks, no LinkedIn think pieces, just 40 years of compounding, and a system they didn't invent but deployed better than anyone before or since, and a track record that every serious acquirer should study before they sign another LOI. In this episode, we're going to discuss the full Danaher story, the founding mythology, the operating system anatomy, the acquisition machine mechanics, the talent pipeline they built, and what it means for how we run deals today. So let's get into it. It's 1981, and two brothers from Bethesda, Maryland go on a fishing trip to Montana. It's not a strategy retreat, not an offsite, but a fishing trip. Stephen Rales is 30 years old, and his brother, Mitchell Rales, is 25. They grew up watching their father, Norman, build a supply company in Washington, D.C., and then sell it to his employees in what became one of the first employee stock ownership plan transactions in the United States. Their father understood that ownership creates alignment, and that lesson stuck. And on that trip, reportedly along Danaher Creek in western Montana, the two brothers had a conversation about what they actually wanted to build. And the conclusion they reached was specific: a company with $250 million in sales and a 10% operating profit margin. That's not a vague ambition. It's actually a precise number and a precise margin target. So these two brothers were sitting next to a river, writing the operating brief for what would become one of the most value-generative companies in American corporate history. They had already started. In 1979, Stephen and Mitchell founded Equity Group Holdings using junk bonds and a sharp eye for mismanaged industrial businesses. Their first real deal came in 1981, and a company called Master Shield. It was a vinyl siding manufacturer acquired for $6 million. And then Mohawk Rubber in 1983 for $90 million, and $88 million of it was borrowed from GE Credit Corporation. The other $2 million came from Master Shield's own cash flows. That is the template in embryonic form. Find a business generating cash, use the cash to fund the next deal. And in 1984, they merged Master Shield and Mohawk into a dormant Massachusetts real estate investment trust called DMG Inc., which they renamed Danaher Corporation. The real estate investment trust's tax loss carry-forwards help shelter profits from the acquired manufacturing businesses. You know, the fishermen know how to fish. And the Washington Post in 1988 described them as the swift, invisible rise of Stephen and Mitchell Rales. Very young, very rich, very private brothers who are into plastics, tire changers, engine retarders, hand tools, and debt and hostile takeovers. So swift, invisible, private. Those three words describe the founders to this day. Stephen Rales remains chairman, and his brother Mitchell remains on the executive committee. And between them, they built a company that would deliver total shareholder returns over 180,000% across 4 decades. And they did it largely without giving interviews, without going on the conference circuit, or without writing a book. But what they did is they built a system, and that system changed how serious acquirers think about operations. Everything about what Danaher became starts with a single factory in Bloomfield, Connecticut. Not the founding, not the raid shell, a factory. And in 1986, Danaher acquired Chicago Pneumatic Tool Company in a hostile takeover for approximately $60 million. And inside that acquisition was a division called Jacobs Manufacturing, specifically a product called the Jacobs Engine Brake, or the Jake Brake, a compression-release braking system for diesel trucks, which is fairly unglamorous but essential. Exactly the kind of business that the Rale brothers were drawn to. And at the time, Jake Brake had a significant market share, but it was squandering it. The company was arrogant to its customers, hiding behind its patents, while product quality deteriorated and service eroded. So customers were starting to look for alternatives. The business was profitable on paper, but it was structurally fragile. The general manager assigned to Jake Brake was a man named George Koenigsager, a former Green Beret who had, after Vietnam, worked at a Japanese-American joint venture and developed a serious interest in the Toyota Production System, or TPS. And Koenigsager knew what lean manufacturing could do. He bought in the consulting firm Shingijutsu, comprised of Tachi Ono's own lieutenants from Toyota's Autonomous Study Group, and began a systematic transformation of the plant. And within 2 years, Jake Brake went from a business on the verge of losing its customers to a lean, operating, high satisfaction, high margin operation. The transformation was dramatic enough that when the Rales brothers saw the results, they asked a single question: how do we make every company we own operate like this? And that fundamental question became what is known as the Danaher Business System, or DBS. Mark DeLuzio, one of DBS' principal architects, was explicit about the origins. He stated originally, Danaher's process was called the Danaher Production System and was shamelessly modeled after Toyota's production system. But they changed the name to the Danaher Business System to reflect a critical evolution. What started out on the factory floor was expanded to every function of the business: sales, finance, human resources, engineering, supply chain. And the system went from point Kaizens, improving a single process, to enterprise Kaizens, restructuring how every function interacted across the entire organization. And the architecture of Danaher's business system rests on 4 key principles, which are simple, durable, and non-negotiable. The first one is around people. Talent assessment is not a periodic HR exercise. At Danaher, it happens during the acquisition due diligence. Every acquisition target gets its leadership team evaluated against DBS cultural standards before the deal closes. People who can't or won't live the system don't stay. The second one is around the plan. Every business gets a strategic plan answering 2 questions. What game are we playing, and how do we win? The plan forces managers to name their improvement opportunities explicitly and produce a shared long-term vision. So therefore, ambiguity is removed. The third principle is around the process. And the DBS toolkit includes standard work, 5S, value stream mapping, single piece flow, SMED, Kanban, visual and daily management, problem-solving process certification, and transactional process improvement. These tools are standardized, but DBS is deliberately not built around any single tool. It is built around a philosophy, and tools serve that philosophy. And the last principle is around performance. Policy deployment, or Hoshin Kanri. Strategic priorities are broken into one-year goals. First-level goals cascade to department-level goals. Department goals cascade to individual action plans. And the cascade is reviewed in policy deployment meetings where target gaps are named and root causes and countermeasures are defined. The system creates alignment, not just activity. One former director of Danaher DBS office described the DBS office itself, and that's the internal body of certified DBS practitioners who deploy to operating companies on request as the secret sauce of Danaher. It's a culture that's difficult to copy, almost impossible. You have concentrated knowledge, and with 25 to 30 operating companies in the portfolio, you build tools with extensive benchmarking. And these tools are somewhat bulletproof. And there are people whose job it is to help you run Kaizens efficiently. And that last point matters enormously for anyone building an operating model in PE, because DBS is not a framework you hand to a portfolio company and walk away. It's a transferable practice with dedicated practitioners, a formal certification process, and a central DBS office that deploys expertise on demand. Danaher built an internal consulting capability before most PE firms hired their first operating partner. And the mantra that governed it all: you had to earn the right to grow. If your operating metrics were not sound, you were not allowed to focus on growth. That, my friends, is not a tagline. That is an operating constraint enforced with discipline across every business Danaher has ever owned. The DBS hierarchy was sequenced. First, get the operational fundamentals right: quality, delivery, cost, customer satisfaction. Only when those metrics are sound does the system grant permission to accelerate growth. This sequencing is what separates DBS from the vague operational value creation language that clutters most PE investment memos. Deluzio's acronym was SQDC&G: safety, quality, delivery, cost, and growth. And in that order. Growth is last. It's the reward for doing the other four right. Let's shift gears and let's talk about how Danaher actually buys companies, because the system is only valuable if the acquisition funnel feeds it correctly. Between 1984 and 2006, Danaher acquired hundreds of companies. From 2001 to 2006 alone, they executed more than 50 acquisitions. But the deal types were always categorized the same way: new platforms, bolt-ons, and adjacencies. Each type carries a different strategic logic and a different DBS integration priority. For example, platform acquisitions establish a new market position, a beachhead in a sector where Danaher did not operate. And these tend to be higher risk, larger capital, and carry the full weight of the DBS integration. Think Lico Microsystems in 2005, which established the life sciences segment from scratch. Then you have bolt-on acquisitions built around an existing platform. So these tend to have same technology, same customer workflow, same competitive space. And they typically carry a lower integration risk and faster DBS deployment and immediate synergies. These are Danaher's bread and butter. And then you have adjacency acquisitions, which move along the value chain or into a neighboring application, sharing the commercial infrastructure or installed base without replicating it. CFID in 2016 was an adjacency to the existing diagnostics platform. But the acquisition criteria are as important as the categorization. Danaher has consistently targeted businesses with specific attributes: niche market leadership, recurring revenue, or high installed base stickiness, defensible technology or proprietary IP, underperforming operations relative to market position, experienced management, and predictable free cash flow. The underperformance is not a disqualifier. It is the point. You're not buying what the business is today. You are buying what DBS can make it tomorrow. And this is the inversion that most acquirers still get wrong. They pay for current performance. Danaher pays for the delta between current performance and DBS-enabled potential. Let's look at their playbook in practice. The Beckman acquisition in 2011 is probably the most instructive case study in Danaher's history. Beckman Coulter was a marquee name in the biomedical diagnostics industry, a business that had built a dominant installed base in hospital laboratories. But by 2010, it was struggling. Multiple FDA warning letters, execution problems, and 3 layers of management that weren't delivering. So the board recommended shareholders to accept Danaher's offer of $83.50 per share, a 45% premium to the pre-rumor price. So the total enterprise value was approximately $6.8 billion. What happened inside Beckman Coulter over the next 3 years became a case study taught at business schools. Danaher removed several management layers, reduced headcount by 8%, generated more than $300 million in cost savings, and cut capital expenditures by more than 40%. As a result, operating margins moved from 10% to 15% in 3 years. And Beckman Coulter went from a distressed asset with regulatory problems to a high-performing component of one of the most valuable life science portfolios ever assembled. This is not exceptional for Danaher. This is the standard. DBS is deployed to every acquisition immediately. The integration timeline begins before the ink is dry. Week 1 of ownership is often week 1 of the first Kaizen event. Then we have the capital allocation engine. And this is the financial architecture of the Danaher model, and it's worth understanding precisely because it is self-reinforcing in a way that most corporate structures are not. Free cash flow conversion at Danaher has exceeded 100% of net income for 33 consecutive years. That's quite amazing. And this means for every dollar of reported net income, Danaher generates more than $1 in cash. This is a function of working capital discipline. Inventory turns, accounts payable management, capital expenditure restraint, all areas where DBS creates direct financial impact. And that cash goes back into acquisitions. The acquisitions improved by DBS generate more free cash, which funds more acquisitions. And the flywheel is genuine, not a slide deck metaphor. And from 1984 to 2024, revenues grew from roughly $300 million to nearly $24 billion. Earnings per share grew approximately 10,000% from 1990 to 2023, and the company did it without blowing up its balance sheet, consistently maintaining conservative leverage ratios, strong credit ratings, and financial flexibility for the next deal. The Danaher playbook, as the company itself describes it, is a 4-variable equation. Core revenue growth plus margin expansion plus strong free cash flow plus acquisitions equals top quartile EPS growth and compounding returns. This simple equation has held across for 4 decades, 5 CEOs, and 3 complete portfolio transformations. One of the most underappreciated dimensions of the Danaher story is what it produced beyond its own shareholders. Danaher is arguably the most consequential CEO school in American industrial history. The Rales brothers had the self-awareness to fire themselves in 1990. After 6 years as a CEO and president, respectively, they stepped back from operational management and brought in outside leadership. They stayed on the board. They maintained their approximately 11% ownership stake, but they handed the operating controls to professionals who could scale what they had built. George Sherman became the CEO in 1989, recruited from Black & Decker, where he had been the chief operating officer. Sherman built the DBS infrastructure, expanded the acquisition machine, and grew Danaher from a mid-size industrial conglomerate into a global operator. Sherman ran the company until 2001. Then Larry Culp joined Danaher in 1990, spent 25 years there, and served as the CEO from 2001 to 2014. And under Culp, Danaher executed more than 50 acquisitions between 2001 and 2006 and pivoted from cyclical industrials into scientific instrumentation and built the diagnostic and life sciences segments that define the company today. In 2018, Culp was hired as the CEO of General Electric, the first external CEO in GE's history, specifically because of what he had done at Danaher. And he proceeded to break up GE into 3 focused businesses, deploy lean principles across GE's operation, and restore shareholder value from a company that had shed hundreds of billions in market cap. The Danaher operating model traveled to GE on Larry Culp's backs. And he actually gave a quote where he stated that DBS tools give all of our operating executives the means with which to strive for world-class quality, delivery, cost benchmarks, and deliver superior customer satisfaction and profitable growth. This was from Danaher's annual report in 2010. Tom Joyce succeeded Culp in 2014, and he deepened the life sciences transformation and presided over the 2019 acquisition of GE's biopharma business for $21.4 billion, what became Sativa, and the single largest acquisition in Danaher's history. Rainer Blair became CEO in 2020 and has led the company through the Veralto spinoff and the post-COVID bioprocessing reset. Jim Lico, who spent 16 years at Danaher, became CEO of Fortive, the industrial spinoff, and has applied the same DBS-derived operating model, now called Fortive Business System, with comparable results. The system spawns systems. The practitioners become founders of their own operating cultures. The talent pipeline is not accidental. Danaher has historically recruited from strong operating environments, put people through DBS immersion, including week-long Kaizen events as part of onboarding, and created a culture where operators advanced by demonstrating the system working, not by managing upward. The result is a company that has consistently produced leaders capable of running other large companies and who carry the DBS philosophy with them when they leave. So for anyone building an operating model, this is the ultimate test of your system. Not whether it works inside your company, whether it produces practitioners who export it when they go. And Danaher did not stay the same company for 40 years. That is perhaps the most important thing to understand about the Rales brothers' long game. They built a machine that could transform itself, systematically, deliberately, and without destroying what it had accumulated in the process. The first Danaher was an industrial conglomerate. Tire changers, hand tools, automotive equipment, vinyl sliding, engine retarders, rubber and plastic and metal. Businesses that were unglamorous, mismanaged, and capable of generating significant cash flows if you applied discipline to their operations. And between 1984 and 1991, revenues went from $300 million to over $1 billion. The DBS was born in these factories. The free cash this first Danaher generated funded the second. The second Danaher was a diversified technology and environmental company. Instrumentation, test and measurement, motion control, environmental monitoring, water treatment. These were businesses with recurring revenue streams, installed bases that created switching costs and technical differentiation. And this version of Danaher made the critical pivot from purely cyclical industrial to mission-critical technology. And between 2001 and 2006, the company made more than 50 acquisitions, and by 2010, revenues had grown to roughly $13 billion. And the third Danaher, the current one, is a pure play life sciences and diagnostic company. Beckman Coulter Paul Corporation acquired for $13.8 billion in 2015, Cepheid, $4 billion in 2016, Sativa, formerly GE Biopharma, for $21.4 billion in 2020, Alvideron for $9.6 billion in 2021, Abcam in 2023, revenues of approximately $23.9 billion in 2024, adjusted operating margins exceeding 28%, with free cash flow that consistently converts above 100% of net income. And along the way, Danaher did something equally important. It exited, systematically, without sentiment, and with value creation for shareholders at each step. For example, in 2016, Fortive Corporation was spun off, industrial instruments, professional tools, software, with a market cap at spinoff approximately $16 billion, and it's today a multi-billion-dollar independent company running the Fortive Business System. In 2019, Invista Holdings got spun off, and that's a dental equipment and consumables company with over $3 billion that is separately traded now. And 2023, Veralto Corporation spun off, which was water quality and environmental monitoring and product identification. And the spinoff carried approximately $4.8 billion in revenue and traded at a market valuation of over $20 billion at separation. Each spinoff was disciplined, businesses that no longer fit the strategic direction of the portfolio, handed to shareholders as operating companies with their own DBS-derived systems embedded. Danaher did not divest to raise cash. It divested to sharpen focus, and that distinction matters. What remained after Veralto was the highest margin, highest growth, highest recurring revenue version of Danaher that has ever existed. The portfolio transaction was not a rescue from crisis. It was a deliberate upgrade. And the operating system made it possible because DBS works on a diagnostics instrument the same way it worked on a Jake-Brake factory. The physics of continuous improvement doesn't change by industry. All right, let's put some numbers on the board because the story is compelling, but the data is what validates the system. So the total shareholder return for the Danaher Corporation from 1984 to 2024 is above 180,000%. And the average annual return since its founding is above 20% cumulative annual growth rate. And for the same period, 1984 to 2024, the revenue growth has gone from $300 million to $23.9 billion. And earnings per share growth from 1990 to 2023 is 10,000%. And the interesting statistic is free cash flow conversion exceeding 100% of net income has had a trend of over 33 consecutive years. And the market capitalization of Danaher as of this mid-2026 is around $134 billion. So let's put those numbers in context. The S&P 500 over the same 25-year period through 2024 returned approximately 800% in total. Danaher's total return in that window was in excess of 3,000%. Morningstar awarded Danaher as an exemplary capital allocation rating, one of the highest designations a public company can receive from that institution. The company is also, according to available analysis, the only U.S.-listed public company that has outperformed the S&P 500 in every consecutive 5-year period since it was founded. Read that again. Every 5-year window. And not a great 20-year run with some bad stretches, but consistent outperformance across every measurement period. And that is the DBS flywheel operating at scale over time. The gross profit margin in 2024 exceeded 58%, and the operating margins 28 to 29% on an adjusted basis. And for context, Toyota's gross profit margin in 2018 was approximately 17%. Danaher's was north of 50%. And we know Danaher is not Toyota, but Danaher took Toyota's operating philosophy and applied it to a higher margin, higher growth business, and the P&L reflects it. And as mentioned earlier, the free cash flow figure, it really deserves some particular attention in the context of how, for example, private equity thinks about value creation. 100% plus free cash flow conversion for 33 years means the reported earnings are real. There's no accounting manipulation hiding in working capital. The cash hits the balance sheet, and then the balance sheet funds the next acquisition. The model is self-financing in a way that most leveraged buyout structures are not. And it does not require constant credit market access to execute. And one more data point worth holding. The DBS influenced spinoffs are not just good businesses, they are companies operating and running DBS-derived operating systems independently. For example, Fortive built on the Fortive Business System. Veralto built on the same operational architecture. The system has not just built Danaher, it has built 3 additional public companies from the same operating playbook. And the combined market value of Danaher, Fortive, Investa, and Veralto represents an extraordinary multiple on capital deployed by 2 brothers who went fishing in Montana in 1981. So what do we actually take from this? If you're an ETA searcher about to close your first acquisition, or an operating partner at a PE firm, or an operator running a portfolio company, the Danaher case is not a story about scale. It's a story about an operating philosophy. And the philosophy is transferable at any deal size. And we can take several lessons from this. Lesson number one, the operating system is the asset. Danaher's most valuable intellectual property was never a product, it was DBS. The system appreciated in value every time it was applied to a new business. It traveled across industries, from diesel truck brakes to molecular diagnostics, without losing efficacy. If your operating model can only work in one sector or one type of business, it isn't a system, it's a checklist. Lesson number two, buy operational potential, not operational performance. The Rales brothers consistently targeted businesses where the gap between the current performance and DBS-enabled potential was large. This is the Danaher edge in deal pricing. If you know you can add 500 to 700 basis points of operating margin through Kaizen, continuous improvement, and policy deployment, you can pay a price that your competitors who are buying based on trailing EBITDA cannot justify. The system creates its own deal logic. Lesson number three, earn the right to grow. And this is the discipline that most acquirers skip. They buy a business and immediately push for revenue growth. New markets, new products, more salespeople. Danaher's sequencing was the opposite. Fix operations first, get quality, delivery, and cost to world-class levels, and then and only then step on the growth accelerator. The counterintuitive result is that the business that follow this sequence often grow faster and more profitably than businesses that prioritize growth first. You cannot sustain growth on a broken operating foundation. Lesson number four, build the system to outlast the founders. Stephen and Mitchell Rales fired themselves in 1990, not because they failed, but because they understood that the system they had built needed professional operators to scale it, and that their role as board members and large shareholders was to set the direction, hold the culture, and get out of the way. The companies that build operating systems depend on the charisma or availability of a single founder are not building systems. They are building dependency. The test of any operating methodology is what happens after the founders leave the building. And at Danaher, the answer to that question is Larry Culp, Tom Joyce, Jim Lico, and Rainer Blair. And the last lesson is portfolio pruning is an operating decision, not a financial one. Every Danaher spinoff, Fortive, Investa, Feralto, was a portfolio decision driven by an operating logic. The question was never, what is this business worth if we sell it? The question was, does this business still fit the operational architecture of what we're building? When the answer was no, Danaher handed the business to shareholders and moved on. This is rare discipline in a world where corporate parents routinely hold on to non-core assets for years past the point of strategic relevance. The Rales brothers did not invent lean. They did not invent the acquisition model. They did not invent policy deployment or Kaizen or the Toyota production system. What they did was commit fully, without exception, across 40 years and 3 complete transformations of the company they built, from a dormant real estate investment trust and a fishing trip. The fishermen from Montana are now worth a combined $13 billion. The company they named after a creek has generated more wealth for more shareholders over a longer period of time than almost any industrial enterprise in the 20th or 21st century. And the system, their real product, is still running. In every hospital laboratory using a Beckman Coulter analyzer, in every bioprocessing plant running Sativia, equipment in every water utility using a Hatch sensor, and every company where a Danaher trained executive took the DBS philosophy and built something new with it. This is what operational alpha actually looks like, compounded across a lifetime. This is Gautam Basu, your host for Operational Velocity. If this episode added something to how you think about operating systems, acquisition strategy, or architecture of long-term value creation, share it with somebody who needs to hear it. And if you find value in this series, then please subscribe. Until next time, take care.
Great returns aren't luck, they're built on the floor. Operators and investors always pushing for more. From the deal sheet signed to the systems in place. Speed without precision is just running a race. Operational velocity, where execution sets the pace.